tonight's panel is called Paths to Tens of Trillions, Store Value, Utility, or Stablecoin Hypotheses. For some quick context on this one, we're going to structure this panel a little bit differently. This one won't be a panel, this will just be a dialogue between Ryan and myself. Ryan is the CEO of a company called Messari. Ryan, if you want to tell us just briefly what Messari is.
Sure. So quick background, I've been in the industry for about 5 years now. Was on the founding team at Digital Currency Group where I was leading our seed investing efforts. DCG acquired CoinDesk and I ran the restructuring for about 18 months. And I also, much like Kyle, got started in the industry just by writing a lot and sharing a lot of my thoughts. So in some way, shape, or form, I've been touching content, data, information in this industry for about 5 years from multiple sides of the table. And my new company, Messari, is working on what's essentially an open source Edgar database for the universe of crypto assets, trying to create a disclosures framework that will help protect consumers and create fairer, more efficient markets that will hopefully ward off some of the worst repercussions that we might see from the SEC if some of this activity goes on unconstrained and unregulated. I know we're going to talk a little bit more about that in this afternoon session because I'm pulling double duty today. So,
and if you guys don't know, Ryan is one of the best people on crypto Twitter. His Twitter handle is 2BitIdiot. He publishes a daily newsletter. I think it's called the Daily Bit. It's fantastic. One of the best kind of sources of information. Always snarky, always colorful, always pretty informed. We disagree about stuff publicly frequently. So for those of you who don't know, we have a fun, open dialogue on Twitter.
It's so nice to be able to argue with you in person.
Much less credible in person, not on Twitter. I like to bring the troll army behind me on Twitter. Cool. So for this panel, we're going to dive into. I wrote a post about a month or two ago called "Paths to Tens of Trillions." The kind of point of that post was just to lay out like what are the hypotheses for ways some of these assets could become worth very, very large sums of money, measured in the trillions or hopefully tens if these things work as we think they might. This stands in stark contrast to the previous panel. The previous panel was very focused on end user applications and building applications for the end users. For this panel, we're not talking about any specific end user application at all, but rather talking more generally about like what is money and like how will value accrue to a money thing? What is gold versus cash? So a lot more kind of abstract economics issues is going to be the focus of this panel. And so in that post, I outlined basically there's like three kind of fundamental hypotheses among crypto folk around like how value will accrue in these systems. One is called the store value hypothesis. One is called the utility hypothesis, and the other is the stablecoin hypothesis. I'm very openly a proponent of the utility hypothesis. I think Ryan is to some degree, although he leans more in the store value direction than I do. And there's a number of folks who talk about the stablecoin hypothesis as well. So we'll touch on kind of what are those three, and then we'll dive into basically the debate of like, why do we think our view is the correct view? So Ryan, if you could start off, tell us what is the store value hypothesis?
Sure. I'm not going to belabor this point too much because I think if you're in this room, you kind of grok the store value hypothesis because that's kind of the original hypothesis around cryptocurrencies and blockchain technology in general, right? That's Bitcoin in a nutshell. A scarce, secure, censorship-resistant, and unseizable store of value that you can hold in your brain and transport across jurisdictions, regardless of who you are, where you are, and it just works, hypothetically. I think a lot of people are drawn to that. I know, when I first got attracted to Bitcoin and got into the industry, it was like many, I think, more libertarian-minded folks that look even at the U.S. dollar and say, we're on the path to $30 trillion in debt in the next 15 years. At some point, this is gonna break. This is gonna crash. And if you look at the history of currencies, the average shelf life of a currency is about 40 years. If you look at the average, shelf life of a reserve currency, it's about 90 to 100. And we've gone through these cycles throughout history, and the end result is that all fiat currencies go to zero. Gold has stuck around and withstood the test of time. Gold, it feels like it's different this time, just because so much is different in the move to kind of everything digital. And so the store value hypothesis in a nutshell is there's going to be some global digital store of value that subsumes much of the demand from gold, and then I believe, and I think many others believe, will slowly start to chip away at not the US dollar at first, but all of the long tail of reserve currencies. So So if you're in a country that has 30, 40, 50% inflation or more, starting to experience hyperinflation, you're going to see a lot more activity. So this happened in Argentina. It's happened more recently in Venezuela. When the Cyprus banks had the bail-in and took a haircut on customer deposits, you saw a big spike several years ago. So I think any country, any populace that is subject to either high inflation or legal and regulatory risk, where they're not confident in their banking system, is an ideal candidate or populace to actually adopt some store of value currency. And I think we may now have hit the tipping point in terms of market cap and liquidity, where this is actually a viable option. I know the last panel kind of dwelled on some of the usability issues, but in general, we are certainly Bitcoin and other store of value cryptocurrencies are more reliable, in some cases less volatile, and even if they are volatile, at least they have upward volatility versus some of the shitcoins that are fiat currencies in other economies outside of the big 5 to 10, 220.
Yes, so I'll kind of add some color on the utility hypothesis. So, and to be clear, both these hypotheses have the end goal of a relatively stable reserve asset that is not controlled by governments, that can't be manipulated, that people can control their wealth self-sovereign, those kinds of benefits. The difference between the utility, I think, hypothesis and the store of value one is how you get there. And so the store of value hypothesis says, just really, really focus on making sure it's a handful of traits. So has to be censorship resistant, right? Like no matter if governments all over the world attack this thing, it has to survive. It needs to be a cockroach. It needs to be secure. It needs to be something that people are comfortable storing their value in. It needs to be something there's no technical risk, like there's no bugs that cause the system to explode. So the barrier overall for technical functionality for the store of value hypothesis is pretty low. It just basically says just be a cockroach, survive, make sure people can access their wealth. Doesn't matter if it's slow, doesn't matter if it's expensive to use it, just make sure the thing works. And very, very low bar. The people will gravitate around that. The kind of easy analogy here is gold. Turns out chemical structure of gold has not changed ever, right, since the Big Bang. And we can rely on fixed number of atoms on the planet, and you can't fake chemistry, and so you've got scarce gold. So the utility hypothesis differs in this, and it says, the key to getting there is not just to be censorship resistant or not just to be, immutable, but that you want to make this thing as usable as possible for as many people as possible to get them to adopt it. And as the people start adopting it, as they start transacting with it, as they start doing things with it, that will make it become the store of value. And so, store of value people say, make it valuable first, then people will exchange with it later. The utility hypothesis people say, make people use it first, and it'll become valuable as a result of that. We don't really know if the cart comes before the horse or the horse comes before the cart, but that's kind of the fundamental debate. And then the third hypothesis is the stablecoin one. Do you want to go for that one, Ryan, or I can?
I don't like stablecoins, so you can take it.
All right. So stablecoin hypothesis basically says, you guys are all joking with yourselves, the only way people will ever use these things is if they're price stable. And so the kind of vision of a stablecoin is to create a stablecoin that is not backed, that does not have a US dollar sitting in a bank account somewhere backing it, but that is backed only by decentralized systems, and that can react to market conditions and produce a stable price. Traditional economic theory will tell you this is impossible. Every traditional peg in history has broken at some point. So it's kind of a crazy concept, but there are a lot of very smart people throwing a lot of money at the idea of trying to build a stablecoin. You might ask, by the way, why would you invest in a stablecoin? It's not supposed to go up. The reason is all the stablecoin systems have some sort of equity component that basically splits up price volatility from the underlying currency, and so you get one asset that's price stable and one asset that's volatile. We won't cover those mechanics today, but that's kind of the third hypothesis for these systems. So, Ryan, we have a friend in a Telegram thread we're on. His name is Murad. His kind of favorite term is hyper-Bitcoinization. Walk us through why is hyper-Bitcoinization inevitable? Well, I don't speak for Murad for sure. But I think the concept behind hyper-Bitcoinization, it kind of what I touched on in the end of my statement, which was Bitcoin or some digital store of value could start to gobble up fiat currencies, starting in the long tail and then gradually consuming more and more global liquidity that
that traditionally would be just a developing economy currency with a market cap in the low tens of billions or even less. And if you take that to its logical extreme, you could get to a point where there is more demand for good money that is scarce and that appreciates in value over time than that which inflates at even 2 to 3% per year. So I am not as fanatical about the hyper-Bitcoinization thesis in general as some, but I do think that it is going to absorb quite a bit of the global store of value. So instead of just putting your money in T-bills or in gold, I think the target market for Bitcoin or whatever the store of value winning cryptocurrency is will be in the trillions of dollars, probably in the tens of trillions. I don't know how much beyond that. But the other component of the hyper-Bitcoinization thesis really comes down to how you price Bitcoin at that point, right? If it gets to $250,000 or $1 million per Bitcoin, the odds are we're not going to be pricing things in dollars anymore. You're going to start pricing them in Bitcoin because the dollar, at that point it could be $1 billion per Bitcoin because maybe the dollar has collapsed or whatever the currency pair that you're talking about is. It starts to become irrelevant, and you really truly just get this one global currency. I find that very, very hard to wrap my head around still, as bullish as I am and have been on Bitcoin, because we still have nation states, and they, I think, are going to want to defend their currency and their ability to print money. So I actually don't look at it quite as fanatically as some people do, but I think of it more as a replacement for gold first, and then the long tail of other sovereign currencies second. Why do we continue to dig up gold and then bury it back in the ground? Right? It's kind of the shorthand for thinking about Bitcoin versus gold as a unseizable store of value.
Yeah, so I'll make the counter on basically that the property that doesn't matter as much as people think is particularly is inflation and supply schedule. So one of the kind of major proponents, Bitcoin proponents make is fixed supply. There's 21 million Bitcoins, never more than that, and that scarcity is what gives it value, right? In Austrian economics, don't print any money. Everyone knows the money supply is just let productivity growth kind of drive economic growth. And so I actually make the argument that inflation is fine in these systems. It does need to be predictable. You don't want the inflation to be subject to political whims of whoever's in office, but I think inflation is fine. And in particular, the reason I like inflation so much in these systems is that inflation allows you to make the system better and more usable. So in all of these systems, you have to secure the system somehow. So in Bitcoin, the miners secure the system. So you've got all these guys running all these computer algorithms, whatever, and the more of them there are running this, the more secure the system is. At this point today, it's pretty incontrovertible that there's really no way to, absent some sort of like bug in the hardware, there's no way to take down the Bitcoin network. Again, a government could plan a multi-year thing and perhaps try, but like at the current moment, there's really no practical way to take down the Bitcoin network, even if you wanted to. So you need these miners securing the system. These miners have to be paid somehow. They have costs, right? They have electricity, they have employees, they have got to buy the computers and stuff. And so there's two ways for miners to be paid. One is inflation, and the other is fees in the system. And those are typically in the form of transaction fees. And so the reason I'm a big fan of inflation is inflation is a way to pay the miners for securing the system. Now, not all systems are proof of work systems with these big power-hungry data centers, but still they have to have computers somewhere maintaining the system. And there need to be many of them, and they need to be all over the world for these systems to be decentralized and censorship resistant. And so I really like inflation because if you make inflation high enough, and I'm not saying 10 or 15%, maybe you can pull this off at 2 or 3 or 4, but at some number, if you can make the overall cost of using the system to end users free or next to free, then that can drive new people to use the system. And basically my view is like get more people to use the thing, they will buy it, but they will also use it, and that will cause more people to buy it and use it, which kind of creates gets the snowball rolling, so to speak.
Yeah, I mean, when I talk about scarce supply, I actually agree that low inflation is probably better, and I've written about this as well. Whatever the winning store value is, it just needs to be less inflationary than the fiat equivalent in the markets, right? So if it's 1 or 2%, that's fine. And I'd argue that that's probably better if the miners in a system like Bitcoin can continue to earn money that way versus through fees, because the fees are regressive. The inflation tends to chip away at the large holders of the currency. So I think we're a little bit in agreement on that. I tend to think that that's a little bit of a false choice, though, because you don't need zero inflation. It's all this is a relative game when you're competing against gold and store value reserve currencies in the existing markets. Because even gold continues to grow at a couple % per year based on new mining. So that is not a deal breaker. We just kind of use like the finite fixed supply as a placeholder. Again, that might be controversial for the super hardcore hyper-Bitcoinization crowd, but I think over time that will probably become more in vogue, particularly as the fee market starts to rise for some of the systems that don't have inflation, and you start to see how expensive it might be to transact on a system like Bitcoin versus something like Bitcoin Cash. I almost said Bcash, and then I could feel Roger Ver like running from whatever countries, and
he's hiding behind the curtain.
Yeah, okay.
So another interesting element to this, and again, like a lot of the Bitcoin folks will make the argument is the big money on the planet. Right, forget about the end users who are trying to use these things. The vast majority of the wealth in the world is controlled by a relatively small number of people, sovereign wealth funds, nation states, the world's billionaires, et cetera. And these people, as they kind of learn about crypto and kind of realize what's going on, they will buy Bitcoin because Bitcoin is fixed supply, and they will be drawn to it because of the inflation schedule. And they won't basically think about fees or usability. They don't care. They just realize it's scarce, and like it's the first scarce thing that no one can take away from you, and that's kind of what gives it its value. And those people don't want to be inflated. The whole point of buying the thing is to not be inflated. One thing I find super interesting about where these systems are evolving is in proof of stake systems versus proof of work. So in Bitcoin, you have proof of work. You've got all these miners mining, running all this hardware. It's not really practical for anyone to become a miner. I mean, it's a huge amount of effort to do it in a meaningful way. But there's a new kind of class of consensus algorithm coming out called proof of stake. And in proof of stake systems, basically, if you own some fraction of coins, you can stake those coins, put them up at risk, and if you violate basically the rules of the system, you have a chance of being penalized. But assuming you follow the rules of the system along with everyone else, then you'll actually be rewarded. And so as the system inflates, you will actually be compensated for doing so. And so one of the ultimate ironies of proof of stake systems that inflate in perpetuity is that, right, if your goal is to run away from inflation, you actually don't want to go to a system that has no inflation. You want to go to a system that has inflation, and you want to be the recipient of that inflation, right, of the seigniorage. And the way the math works, of course, is so long as less than 100% of people are staking their tokens and receiving inflation, then you are guaranteed to beat inflation by staking. And so I think it's very interesting as we are seeing sovereign wealth funds and other large name people buy these things, and it's not clear to the market that you can actually beat inflation and be the recipient of seigniorage. Ironically, it's very reverse Robinhood, right? A lot of people in crypto think like Robinhood, like democratize access and all this thing. But this system, in practice, will likely be reverse Robinhood, where
it's a rentier class.
Exactly, right. So it's just a very interesting dynamic that's not discussed very frequently, and I think is worth understanding. Ryan, I don't know if you have any additional comments for that.
No, I agree. Can we start arguing?
All right, poke some buttons, push some buttons.
All right, let's talk about utility tokens.
Most of them.
I think Kyle gave his thesis for utility tokens, and I don't disagree with the framework. I just generally think that utility tokens as a class are overvalued by orders of magnitude. And the exception that you can very easily look at is Ethereum, right? It's had this massive run up. It's been used to facilitate decentralized applications on this network. It's been a massive wealth generating event. And that's all true, but I would actually argue that Ether has gotten where it is today because it has become a store of value versus a utility token. And the reason I say that is, you can think of Bitcoin as the reserve currency for this algorithmic central bank. Basically people have said, screw the Fed. Ether did not grow in value because people are paying for gas and to create crypto kitties, right? Ether grew in value because it became a reserve currency for this distributed central bank that circumvented the public securities offering process. And it was basically for people that said, screw the SEC, right? So in my eyes, you've got these two reserve currencies, and the things that make them really valuable are the creation myths associated with them, and the collective delusion that these communities have over the potential of these assets to actually be viable reserve currencies for these ecosystems over time. That really isn't a utility thesis, right? Like, yes, Ether is usable, but its killer app is fundraising, right? The killer reason to hold Ether is because you believe more projects are going to raise money via ICOs where they collect fees and maintain their balance sheets using Ether. So I think we generally agree on some of the classifications of store of value versus utility. But when I think about the value of these things, I think about why do you hold it long term? You hold it only if it becomes a form of money. And I haven't seen any other utility tokens right now that have created this kind of cultural movement or collective delusion or groundswell of support and a really strong ethos that would support something that looks like money, which is really just a shared illusion.
So I generally, most utility tokens, and there's a lot of utility tokens that are in the 9-figure valuations today, that these things are intended for a very specific application. Certainly on a risk-adjusted basis, those prices aren't warranted. Maybe they could mature into that kind of value over time, but given the risk involved, it's hard to argue for a 40% discount rate and projecting these things to be worth 30, 40, 50 billion. That's not viable for most of them. We've said very publicly that we're making a lot of bets on smart contract platforms, and the thing we're betting on very explicitly is that these other smart contract platforms can evolve from just a utility platform where you are paying for gas or paying for access to the system to becoming a store of value, to becoming a money thing. And so you can think of all of these things, right? The only way to justify Bitcoin's valuation today, Ether's valuation today, even EOS's valuation today is as a call option on becoming a money thing. And there's no other valuation model we can come up with that justifies it. So I totally concur on that. It's going to be a real challenge for the other smart contract platforms to do that. But the idea is, if we have the proof point that Ether, can become a money thing, or at least can become a viable call option on a money thing, then if other platforms can become used by developers and app developers and all these things, that they can make the jump from just use it to pay for gas to becoming a real place to store wealth.
Do you think that some of these platforms can buy their way into communities?
I think they can use money intelligently. Generally, like the earliest adopters are generally pretty ideological with most types of systems. All the early Bitcoin people were very ideological. A lot of the early Ethereum people were also as well. The kind of next wave of people getting into crypto tend not to be ideological. So they're just going to be less married to their systems. And if things aren't going as according to plan, they're less likely to stick around. Ethereum had a rough 2016, and a lot of people stuck around. And so I think you do need that groundswell of support to maintain the system. But I think using capital to your advantage, and Ryan's asking a very pointed question about EOS right now.
No, it could be XRP, it could be any of these that raise a ton of money and plan to deploy it in ecosystem development. Not just picking on EOS.
Fair.
I can.
And so I think capital is a tremendous asset. And this kind of ties into a thing I wrote about a week ago called Good Artists Copy, Great Artists Steal. And the idea with all these systems is they're all open source. Right? Like none of this, there's any IP here that's proprietary. There's no patent protection of any form. And so individual features are copyable. And we already have plenty of evidence of this, that features are being copied between systems, both with code merges and forks and all kinds of other kind of technical mechanisms. And so my point is, if you assume that all features are copyable, then the only thing that can really separate any of these platforms are basically ideologies. What's your inflation? You can't have an inflationary and disinflationary monetary supply, right? Those are mutually exclusive. You can't have tightly coupled on-chain governance and informal off-chain governments. Those are mutually exclusive. And so there's a number of these ideological kind of questions in these systems, and it's very much TBD, like which set of policies, basically, and ideologies will attract people and get most users. But the interesting thing about having capital for the team is that if they're willing to bend the technology and copy features, and if they're even willing to morph their ideology at least a little bit, not can't do a 180, but at least be willing to pivot, then having capital is a tremendous resource because you can basically pay for developer relations, pay universities to educate developers, pay government affairs people, right? I mean, like you need to bring these things to market. And so we're very bullish on the idea of teams that have large balance sheets that can basically, you can call it bribing in I think the most cynical sense, but I just call it go-to-market, which is like, you got to get out there and talk to people and like get them to use the thing. So I'm quite bullish on teams that have large balance sheets. Ripple accepted.
Yeah, I mean, I think that Ripple's go-to-market is very similar to some of these others that are using, ecosystem development funds or trying to incentivize people to adopt their platform and switch from Ether. For me, it really comes down to what's going to cause people to stay, and as switching costs get lower and lower, I think you have to look really closely at culture and ideology. So, you're talking about feature changes and changes to things like the consensus algorithm or inflation schedules, or, I agree, right? These good teams are going to steal open source code. And we need to find a better way to describe stealing, because it's not stealing, it's open source. Sorry. You raised a ton of money for these projects that are open source, and with this very aspirational message that this is going to decentralize the world. And now I think, in the next couple of years, you're going to see a lot of people start to get petty about, such and such team basically just took all of our innovations. Well, of course, because it's open source. You had an opportunity to develop and you raised capital to, form this nice R&D syndicate, but everything that you publish is ultimately accessible to the broader community. And the communities that I believe are going to win are the communities that started community first versus code first. As long as you have a halfway decent technical team and a halfway decent business team, whether that's in a centralized entity that has outsized control over the network at an early stage, or it's just kind of a community of really intelligent people that believe in a given idea, that's going to be much, much more important. And I think it's dramatically undervalued in the industry right now, just based on where we are in the hype cycle. You've got a lot of projects that have raised a lot of money, and everyone's like, this is going to be the next Ether. I'm going to make 10,000x, or this is going to be the next, Dogecoin Dark Verge, right? And we're just going to make a ton of money, and because we've made a lot of money, we're going to distribute that back out, and everybody else is going to feel like they're making a ton of money. And that sounds a lot like a pyramid scheme. And the same is true for Bitcoin and Ether, by the way. But the difference between those two communities, I believe, and we could probably argue this point all day long, is that there's still like a religious contingent to both of them. And I actually don't necessarily know if EOS is going to have that groundswell, or if XRP is going to have that groundswell, or if Definity is going to have that groundswell. Many of them might. But my point is, I don't think you can buy that, right? I think it's just something that somehow you need to hit a tipping point where people just get this collective belief that they're part of something that's bigger than themselves, and it takes on a bit of like a philosophical, religious type of vibe for the people that are participating. Otherwise, I don't see a way that you can get to a store of value currency from a utility.
So I generally agree. You can't bribe people to believe something, right? Like extrinsic motivation works for people who like need to do a job to get paid, but like people who have to do challenging work and think about things, like extrinsic motivation doesn't work. So bribing people, again, in the most cynical sense, to do something is, I don't think is viable. Money is a collective vision. For those of you who've read *Sapiens*, Yuval Noah Harari articulates this quite well, right? But money is just an illusion between all of us about like, well, this is the valuable thing, and here's how we exchange value. And so you're going to need this groundswell. I do think teams with money, though, can use that to get there in much more intelligent ways. Part of it is the ideological. You need to have an honest, true ideological base. It needs to be justified, and people need to believe it. But then you need to spread the word. And my biggest concern for crypto, especially the Ethereum community and the Bitcoin community more than others, is they're very insular to people who have found them and bought into the ideology. And like, you need to cross the chasm. Right? Like the vast majority of people on the planet do not care about inflation schedules and smart contracts and formal verification and all these things. And so the reason I'm very bullish about aggressive go-to-market teams is their willingness to basically be missionaries and go spread the word. And that takes time. But you do need to have the base there has to be, you got to build on a real base.
I think there's a big difference between Herbalife salesmen and missionaries. But we don't know which of these projects are actually going to build that ethos, right? So again, I'm not criticizing any of these other platforms, but in my mind, what it takes to cross that chasm is you need to graduate from that somehow by starting mission and ideological first. So I think we're somewhat aligned, but I think we disagree on some of the specifics.
All right, let's talk about stablecoins, everyone's favorite super controversial topic. So there's been a stablecoin thing called Maker for a while. The team has been around for a few years. They built a model that's collateralized. So the idea is you basically can put Ether in the system. The system will issue this new stable coin called a DAI. The DAI is worth $1. That DAI is debt. And basically the only reason to get DAI is if you want to go levered long Ether, right? So you can get levered exposure to Ether. Maker's working on generalizing the system to work for other assets, but the Maker system is, in principle, is a way to deposit an asset, get a loan against it. It's just credit, right? In very simple terms, the Maker team's been around for a while. They just launched in December. The system seems to be working. It has not collapsed yet, although Ether has fallen in price substantially. The system as a whole has functioned more or less as advertised. A new idea kind of came around in mid-2017 called Basecoin or Basis. The model is called seniorage shares, and the idea is to create a central bank that is algorithmic, and that central bank can basically control the money supply, either print new money. Printing money is quite easy, or create incentives to contract the money supply. And there's a whole bunch of teams who have different ideas on how to do this. The Basecoin team was basically the first one to pursue this effort in a meaningful way. They raised a tremendous amount of capital. I think they just raised $130 million at a $800 million valuation. And the team's about 6-7 months old. But a lot of people are excited by the vision. And then since that happened, there's 30 teams that have popped up that said, oh my God, I got to go try and build a stable coin. Most of them are adopting the seniorage shares type of model, but with some tweaks. A lot of people call them impossible. I'm very excited for them.
Do you want to talk a little bit about the seniorage shares model?
Yeah, but with what specifically?
It's just like how it works.
Right, okay, so I'll talk about the Basecoin implementation. There are others with differences. So the idea in Basecoin, or it's called Basis now, you've got your stable coin, it's worth $1, and basically you need to figure out what do you do if the price goes up too much or the price goes down too much. So if the price goes up too much, the answer is very simple. You just print money and hand it out to people. In the Basecoin system, there are 3 types of tokens. There's the base coin, the one that's stable. There's what's called the equity token. And then whenever you print money in the system, you hand it out to the equity holders. And then those people will sell it on the open market for whatever they want. And you can get new supply on the market to increase supply and bring the price back to equilibrium. The really hard problem in these systems is how do you contract supply if the price decreases? And so in Basecoin, they create a system, they call it the base bonds. They're not actually bonds. They look like bonds, but they are definitely not bonds. And the idea is the system, you can take one of your stable coins, deposit it in the system, and then get a bond, and you can do this for less than the par value of less than $1. The par value will be one stable coin, but you could purchase it for less than this, so 95 cents, 90 cents, whatever. And then if the price is decreased, basically this market will exist to buy these bonds at some discount. And the idea is whenever demand returns in the system, right, then you'll start printing money again. And the first people you will when you print money, the first people who get paid are not the equity holders, but are the bond holders. Again, they're not actually bonds. They're not fungible. There is a priority order to them. But that's kind of the system in a very simple terms.
So, these systems work as long as there's bondholders, right? So, I like to say, crypto needs its XIV too. And I guess for those that don't know, because you didn't laugh, that's the ETF that just blew up, which is the inverse of the VIX in the public markets, and it's very predictable that there were certain scenarios where this ETF would basically implode overnight if it traded out of bound and out of certain parameters, and that's basically what all of the stablecoin models have at their core, right? It's these embedded assumptions for what is a reasonable amount of volatility that we can absorb, and the system will still work, and we'll still have a buyer of last resort. And I think the problem is that over time, that reserve gets smaller and smaller in most of these systems, so you become more susceptible to shocks. And the counter is, well, there's more liquidity in the system, so that's less likely to happen. That's a loaded assumption, number one. And number two, in the early innings, the investors in these stable coins don't really care because they're going to get paid out. The likelihood that they actually make money from the seniorage shares is very high, which begs the question, who's holding that bag on the other side of the trade? Now, I'm not saying that all of them are going to fail. Many of them are going to be useful. Maker has defended its peg even in a pretty volatile environment a couple of months ago. But one, as these stablecoins start competing with each other, and two, as we have some type of not black swan events that is entirely predictable because you've had volatile markets in crypto for as long as they've been around. What happens during the unwinding, and which stablecoins, if any, will be able to withstand the shocks and continue on. So that's the $10 trillion question, really, with these.
Stablecoins, yeah. So internally at Multicoin, we generally are skeptical of the senior shares model. The big challenge as an investor is to put on your hat and say, will it work enough in the short term that it's interesting? And the answer probably is yes. It's hard to argue that it's not interesting and that you probably won't at least be marked up. The question is can the system work in the long run? And there's a very real probability these things work for 8 years and then explode in year 8, right? It doesn't have to be that it explodes in year 1 or in year 2. And so it's a real challenge. We are generally pretty skeptical. Market whenever the floor lets out in markets, right, they tend to collapse. And the problem with these systems is the first time it's tested and fails the test, then the system becomes worthless and it'll go to zero. So we're generally pretty skeptical. We like the maker model, and if you take the maker model, which is again just basically you're issuing debt against assets you own, it's hard to argue against that. Fundamentally, I mean, it's a stable asset. It's backed by whatever you say it's backed by. As long as you can enforce the liquidation if the time is right, then it's pretty reasonable. The biggest problem in the maker system is that the demand to create new stablecoin is not tied to demand for the stablecoin itself, right? So if you want to create debt in the system, you need people who actually want to go get debt versus people who want to go shopping and buy food or use it as some sort of stable currency. And so that's kind of been our biggest challenge with the debt model is, right, I'm thinking, how does it grow exponentially? It just, there's not a clear path because the demand drivers are just fundamentally different things. But yeah, we are pretty skeptical of the senior shares model. We're also excited and we're trying to figure out how to make a bet on it because it's worth trying and seeing where it goes. But the fears are real. You got anything else to add to that?
Nothing on stablecoins. I mean, we could spend a couple minutes talking about non-platform utility tokens if we have time. I don't know where we are in time.
I think we have about another 5 minutes until Q&A.
Okay.
So.
I don't think that kind of this long tail of utility tokens. So these are resource tokens. I know you just heard Vinny talk about Civic, and there's Filecoin, and digital resource tokens. I think could be very valuable. I end up looking at those more as technologies and networks that could create trillions of dollars of disruption, but probably capture a small fraction of that. And I know, I don't know if this is a subject that you've written on, quite as much, but it's one that that I know I've been spending a lot of time thinking about. Can you actually think about any of these tokenized application networks as intrinsically valuable? And if so, how do you even start to think about price, right? The utility token, the utility platforms, right? Dfinity, EOS, some of the others that we already discussed, they're trying to graduate from just a general purpose computation platform into a form of money, right? Well, I think most of us agree that that's a pretty valuable opportunity. How do you value things like distributed digital storage or computation or right to work in a given network, right? Something like Numerai for data scientists or Augur for prediction markets, where you need to own stake in the system, stake tokens in order to have a right to earn application fees as part of these new marketplaces. There's a number of really interesting information resources and purely digital assets that are getting tokenized right now, and probably eliminates markets for pennies on the dollar that exist today in a more centralized fashion. That's really interesting. It's harder to see how that gets captured.
Yeah, so we generally we wrote about this kind of the velocity problem, which for if you just create a currency for payment, the velocity will increase as people hold their money thing, convert into your currency, use the service, and then whoever receives the payment converts back to the money thing. It's very quickly easy to see how those payment currencies never really accrue value. We wrote about this, I think in January. We're seeing some teams, and I think Keep is really one of the pioneers of this, creating models where you can at least value this token using a DCF, where there's a rational reason why people pay money into the system, and that therefore rational holders of the token will hold it because they're receiving some sort of stream of cash flows. Overall, though, it's going to be pretty hard to justify. I mean, right, if you're seeing, I'm going to pick Omisego as an example. It's probably I think it's the single highest valued utility token that is not a smart contract platform or a base layer chain, and if you assume a 40% discount rate or even a 30% discount rate for these things, given that it's currently worth, I don't know, 1 to 2 billion, like whatever the implied market price is, I can't construct any model in which, given the discount rate, that it can be worth that much. There's maybe a case that it's worth $1 billion in some sort of, terminal state, but it's impossible to justify, and that's true for the vast majority of application tokens today. So with that, we're done with our session. Guys, questions, Q&A. Miles, if you can get mics to people.
Everyone's sick of us.
I have a question. Is this on? So you talked about Bitcoin and sort of the idea that you like fixed supply versus low inflation. Do you think that, what do you think about a future in which Bitcoin moves off of the block rewards model, and what does that mean for the future of Bitcoin?
So just a transition to a purely fee-driven market?
Yeah, and I guess there's questions about security there, and if Bitcoin can't be as secure in that model, what do Bitcoiners do?
Well, I think the answer is pretty simple. The miners, over the course of the next 5-6 years, are going to you're going to see what the lower bound is that they're willing to work for in terms of a percentage of annual inflation. So the way that I tend to look at it is you look at the inflation in terms of new Bitcoin generated plus the fees, and then whatever that is divided by the total current supply. That annual inflation, we don't know yet what the lower bound is, where the miners are basically going to say, the fees have to rise, or we're going to turn off our rigs and stop processing transactions. I don't think that we know that or are going to know it for the next few years. So it's kind of like a 4-year from now problem, which is an eternity. And Bitcoin might not even be around by that point. I don't know.
Just for context, so every 4 years in Bitcoin, the rate of inflation per block goes down by half. So I think the system started at 50 Bitcoins per block, if I'm not mistaken. I think in 2016, the system reduced inflation from 25 Bitcoins per block to 12.5, and that's what currently is now. And the system is at some point in 2020 going to transition to 6.25 Bitcoins. Keep in mind, right, people are always adding new mining power to the system, and so your miner is producing less and less income over time, or at least less and less fewer and fewer Bitcoins over time. So you need the price to be going up, kind of constantly, basically, as a miner to make the system work.
It's 3 or 4 years where it dips below 2%. To me, that's kind of the number to look for, as soon as the annual inflation drops below 2%.
Yeah, I think that's going to be in the early 2020s. We're not too far away from that state of the world. I'm generally pretty skeptical. No one in the Bitcoin community I've seen has proposed a serious answer other than fee market. And like they say, we'll have off-chain transactions. I'm not really convinced that it'll be economically viable to even run enough on-chain transactions for anyone to use the thing in a material capacity. So I'm pretty skeptical, and I haven't seen any good answers.
Hey. It's really interesting to think about these 3 things kind of in a vacuum. I think all 3 will probably be really big. All 3 of them kind of have to compete with incumbents, like from traditional financial markets or traditional technology. Can you talk a little bit about like which one has the clearest path through the competition, whether it's governments or like big corporations today or money today?
I think I answered it in my first comment. I personally think it's still Bitcoin. And the way that I could back into that is looking at developing economy central banks who at a certain point have to start thinking, what do we have to lose? Our currency is getting inflated at 5 to 7%. We're a couple steps away from hyperinflation. Why don't we just stock up on Bitcoin with our soon-to-be hyperinflating currency? And then we'll at least have some type of stable store of value that can withstand any shocks to the broader system and potentially even migrate. And just from an expected value standpoint, we don't really like to talk about it, but North Korea has probably been doing quite a bit with Bitcoin. And that immediately makes them more of a credible player internationally. If you think about North Korea, it's nuclear weapons, cyber warfare, and Bitcoin, all asymmetric opportunities in terms of how they could capture value with a pretty small empire. I use that tongue in cheek. But I think if you look at maybe less nefarious and non-OFAC sanction regimes, a similar calculus could start to come to the forefront of some of these bankers' minds, where it makes sense for them to put a small part of their coffers with the expectation that could become 50 or 100 or multiples of what was in their coffers otherwise. So that to me seems like a viable path to getting Bitcoin in a long tail of countries and basically mitigating the risk that this just becomes like a blacklisted currency that is technology non grata in the G20 circles and becomes blacklisted for whatever reason.
So we're running low on time. I think one more question, then we're going to have to go to the next panel.
Hey, so you chatted about these 2% as being some kind of like magical number in which things turn. Wouldn't inflation on its own, as long as it's predictable, just like be priced in at any given point in time? So as long as you know that it will be 2, 3, or 4% in the future, your model for like knowing at which price to buy should account for that. Or I guess like tangential to that, why is necessarily like lower inflation better, and why is not a deflationary currency overall like even better as a store of value with that line of argument?
So, I mean, I think there's a very natural draw to like no inflation, because if you like Austrian economist view and you believe it's evil the governments print money, then it's like the logical conclusion is like give me a thing that can't be inflated. And like that's why people like gold, although they're mining new gold. Like it's understood that you can't fake chemistry. So I think there's a very natural intuitive draw to that. Our concerns about inflation, I think specifically the last few minutes have been more about the miners, and like these people have to be compensated somehow, and they're not going to run unprofitable mining operations. And so there's a very large open question in the Bitcoin community of like, how will that work? And it's not clear. In proof of stake systems, that is by and large not a question, because the cost of maintaining the system in cash cost is much lower. But yeah, it's TBD on the like, can people pay to keep the thing running? All right, so I think we got to go on the next panel. We're running a little behind, so thank you all again. Appreciate it. Ryan, thank you.